Hello, my name is Oliver. I am one of the directors and advisors here at Your Wealth. We thought we'd put together a video about recent events that have received wall-to-wall press coverage. These are the Trump tariffs that have caused a significant sell-off in markets. Indeed, we've seen the S&P 500, the American stock market, sell off around about 13% from its high earlier this year. The FTSE drop is down about nearly 5% today, Monday the 7th of April, and sold off significantly Thursday and Friday. Now, what does this mean? Is it time to batten down the hatches and sell everything into cash until things improve? So at times like this, emotions tend to run quite high. There's quite hyperbolic and 24-hour media coverage of any market falls and any dramatic responses, any policy and tariff changes tend to get a lot of platforming and coverage. Now, this is often where some of the biggest investment mistakes are made. We have no idea what the stock market will do next. And indeed, you should be very wary of anyone who says that they do. But what we can do is perhaps learn a few lessons from what has happened to the stock market historically. Now, let's zoom out a little bit from what's going on at the moment and look at more recent history. So if we look at 5 years ago, the last really big market sell-off was during the global pandemic, during COVID. And even 3 years ago, there was a very large market sell-off following the outbreak of the Ukraine war in 2022, at which point the lowest point in the markets over that time, the global stock market following the Ukraine war sold off to about 26%, so pretty severe. You may have noticed that your funds, though, will have sold off. They would have declined over that period. They wouldn't have declined as much as 26%. That's due to the fact that we tend to invest in a more diverse range of assets that provides a bit of ballast against some of the worst of these crashes and declines that occasionally occur. So the reason I mentioned these previous crashes is to put them into a bit of context and talk about a little bit about the regularity with which they occur. When investing in the stock market, we would prefer it, in an ideal perfect world, for our investments just to steadily rise with no periods of decline. Now, as our clients know very well, unfortunately, this is an impossibility. Even in good years, we can have a year where, for instance, we could take a year where the S&P 500, the American stock market, has returned around about 10%. During that year, it's not uncommon for there to be quite a sharp decline. For a period, the markets could have declined 5-10% before recovering and then showing a 10% return, positive return by the end of that year. In fact, what we call a market drawdown, which is when markets decline, that's often happens, I think it's 1 in every 4 years in the American market, more 5% or more. So these are sadly quite common occurrences. Some drops last longer and are steeper than others, but markets have always recovered, even though every event previously that's caused a crash has seemed like a world-ending event that we would never recover from, or if we do recover from it, things would look very, very, very different and stock market returns would be more muted as a result. Now, if we look previously, you could point to obviously the COVID pandemic, the financial institutions of the West failing in 2008, causing the massive financial crash, the dot-com bubble bursting in the early 2000s, we had Black Monday in the late 80s, any number of global events you could point to that at the time seemed like they were going to be pretty world-ending, we have historically always recovered from. Although it's tempting to batten down the hatches during these times and sell all of your investments into cash, evidence shows that this is one of the biggest mistakes that you can make. Timing the markets is incredibly difficult, and normally if someone has timed the market, it's through luck more than design. Now, if you sell down into cash during a market crash, evidence shows often what this will result in is a compounding of your losses and a significant impact on your future longer term returns. Now, the reason being is because markets can recover very sharply and very quickly before you are able to re-enter them from cash. This means that you miss out on the best days of the markets, as market recoveries normally show some of the sharpest rises in markets and the sharpest increases to investment values. Missing out on these leaves you stranded in cash, having sold down on the way down and having to reinvest on hype as markets rise, buying back stocks at a significant premium to where you sold them. Now, I don't wish to diminish what is going on at the moment by any means, but we have been here before, not in the nature of what's going on, but certainly the scale. And indeed, I think some economists would argue that the scale of previous events outweighs that we're going through at the moment. Markets have historically always recovered from these events, and they bounce back, and they bounce back strongly. When you're investing in the stock market, you're effectively investing in human ingenuity to overcome obstacles that are presented to us and progress, something that we have always achieved. So what do we learn from all this? We learn that by keeping a cool head and staying the course, you can ride out these storms. You will benefit from it in the longer term when markets bounce back, as has happened historically, though it is very unpleasant when you're going through it. And of course, due to this unpleasantness, we completely understand that you will likely need further reassurance and further guidance as we navigate through what is going on currently. So I would encourage you, please do pick up the phone and give us a ring if you would like to receive any more guidance and reassurance around what is going on with the current tariff trade war.